Hey guys, Israel Favela here with Clearview Realty. I'm a real estate agent out here in El Paso, Texas, and I'm glad to bring a good friend of mine, Mitch Davis, who's a lender here in El Paso with Change Mortgage. And the reason I bring him on here is because I've had several people reach out to me asking certain questions about getting pre-qualified and about the interest rate. So I wanted to bring him on here to give us an inside scoop of what's going on and just kind of guide us through the process. But I want to give him an opportunity to introduce himself. So Mitch, why don't you tell us a little bit about yourself?
Hi guys, thanks Israel for having me on. Really appreciate the opportunity to be on your YouTube channel. My name is Mitch Davis, born and raised here in El Paso. I work for Change Mortgage, as you mentioned before. Been in the industry for a little over a year now. Super blessed to be able to start when interest rates were so low, and now obviously interest rates are a little bit higher. So happy to discuss that with you.
Yeah, for sure, man. And I'm glad that you're on here because you're like you said, the interest rates have crept up significantly, causing people to not qualify as much. But I wanted to start off with that. So what are the rates looking like right now? And do you anticipate them going up significantly more or down? Like, where are we at right now with the rates?
So interest rates have gone up a little bit, and you're right. Having people pre-qualify and be on new construction contracts. Now the interest rates have gone up a little bit. It's harder to get them to qualify as far as their debt to income and everything else. But interest rates right now, VA and FHA, you're kind of looking in the high fours, maybe a 4.875, sometimes in the fives. For conventional, you're looking at right around a 5, maybe a 5.25, depending on the day. As far as rates and how they're going to change, it's if I knew where they were going to go, I'd probably be doing something else. I'd probably be in the stock market right now, be on Wall Street. But from everything that we have and that we know about, we think they're going to rise just a little bit as far as the end of the year. Coming up to the end of the year. But hopefully they go back down. I think we've been a little bit spoiled with COVID and rates being in the low 2s, mid 2s, then the 3s, and then now I think we're kind of leveled back out to where we were historically.
Yeah, and it's crazy historically. I think I've seen a chart itself where it says like the rates were at one point like 8%, 9%, like way back in the day, like in the 1990s, and it's slowly crept up. But for us to even think and imagine that last year was in the 2s is just crazy to me. But you were speaking about the new construction, how at times where they're under contract and it's crept up, and that's caused their how much they can qualify for to drop a little bit. Has that happened to you as well?
It has, and those are those hard conversations we have to have with people, because when we do a new build, when we do your debt to income, we know that it's going to be at least 6 months, 8 months, in some cases 12 months out. So we try to overestimate all the fees and especially the interest rate, because we don't know where they're going to be. But when we were trying to qualify you, were using a 3% interest rate like we were this time last year, and then now we're kind of in the 4s, 5s. If they're doing down payment assistance, could be the 6s. That rise in your debt to income as far as your monthly payment, that could get people in. And we have had to have those conversations with people and say, hey, look, your payment was $2,000, but now with the rise in the interest rate, you're looking at $2,400. Is it still something that that you guys can afford? And if you can't, we need to kind of go back and figure out those options for you, because at the end of the day, we don't want to set somebody up for failure. We want to put you guys into a home and put our buyers into a home and have their best interest at heart and have a payment that they're comfortable with.
Exactly. Yeah, no, that's definitely right. But let's jump into some of the fees that a buyer can anticipate whenever they're purchasing a home. So let's start off with the down payment, because I know there's various commonly used types of loans that it varies on the down payment, right? Could you kind of go over that with us?
Yeah, sure. So your down payment, you have your minimum. For FHA, you're doing 3.5% of whatever your purchase price is. That's usually the lowest of something that you're going to have to pay. VA obviously has no down payment. And then with conventional, you're looking at usually about 5%. Now there is an option for a 3% if you're a first-time home buyer, but that's a conversation we like to have because the interest rate is a little bit higher for putting less down on the home. So VA 0, FHA 3.5, and then conventional usually about 5%.
Right, and we'll talk about it later, but those are really predicated on the types of loans that you qualify for is predicated on your credit score and other information, right? So, okay. Yeah. And then as far as the closing costs, so that's a misconception. I know we were talking about it earlier with the VA, but Tell us a little bit about the closing costs. What kind of percentage are you looking at? Where are we at with that?
Yeah, so I think that's another thing with COVID that came out and it becoming a seller's market. Before that, sellers are not having to pay. Sellers are paying your closing costs, and then we go into COVID and it's a seller's market. And if I want to win a bid, I'm telling the sellers that I'll pay all the closing costs. So the rule of thumb that I use with that, or just an easy number, is if you're buying a home that's $250,000 or less, you're looking at about 3%. And that's going to cover everything: your appraisal, all your prepaids, your homeowner's insurance premium, your prepaid interest. It's going to cover everything for you. So I tell people that, there is the appraisal cost, there is the inspection. So if I tell them 3%, it's easy for them to do the math. Once we get a loan estimate out to them, we can, kind of give them a better number and go over all fees and costs. But 3%, 250 and below, 2.5% if you're going above 250. So.
Okay. Yeah, no, that's a good rule of thumb. So I know that with what you're talking about with the seller's market now, there's been instances in which I'm sure you've experienced too, where I have a client that's a VA and they spoke to someone else that used their VA loan as well before COVID. And they themselves, that experience that they're hearing is that they got all their closing costs paid for. They didn't have to put a down payment. So a lot of times there's that confusion between down payment and closing costs, like you were mentioning, and they think that they don't have to put any skin in the game. But now it's kind of completely flipped on its head, right? But with so whenever they do a resale, a VA, let's say for instance they're purchasing a resale home, they're going to have to come in with that 3% or 2.5%, depending on where the sales price is. For new construction, I know that you're a preferred lender for various builders. How's that looking with? Is that an instance in which they can, not come in with any closing costs as well?
Yeah, so if they go with one of our, we're a preferred lender to many builders. If they go with Icon, if they go with Desert View, Saratoga, Casas de Leon, there's some more in there too, but I'll have to look at the list. But usually if they go with the new build, we get at least 2% from those builders, and we can cover most of their closing costs. Especially with VA, we try to take care of our vets and do as much as possible, little amount as possible coming out of pocket. With a new build, we can work with them and we can work with the builder and kind of see what we can do. But for resale, VA, I think that's a common misconception that they come in with zero. For the down payment, that is true, but for closing costs now, with sellers paying nothing, and for you to be competitive in this market as a buyer, they do have to come out of pocket. And it's just like any other investment. You can't invest, or you can't borrow six figures from a lender without putting some in yourself. So 3% is usually the rule of thumb that we use. There's so much that goes involved into it, so using the 3% under 250 gives us kind of some leeway there, and kind of helps them have a number in mind when it comes to closing costs.
Awesome. Okay, so yeah, that's good that there's at least an opportunity for them to purchase a new construction home without having to pay any closing costs, but it definitely has to be with a preferred lender. So we've talked about the down payment, the closing costs. What about the appraisal? Is there like certain prices that are dependent on the type of loan that they got? Like where's the appraisal value going on to pay for it?
So as far as like cost of appraisals?
Yeah, exactly. Mm-hmm.
Cost of appraisals. So when we order appraisal, we order it from a queue and it gets picked up. With VA, they do have a set price. It used to be $500. It was a set price for VA. VA is very strict on what fees you can and cannot charge. There's VA non-allowable fees that they have associated with closing and all those fees that they add up in there. But so for VA, you're looking at $800. I think there was 3 counties in all of Texas, El Paso being one of them, where the VA appraisers were kind of falling behind, and they were taking 2 to 3 weeks just for them to assign the appraisal, and so it was taking 4, maybe 5 weeks, sometimes longer, for us to get an appraisal back for VA. So they upped the price in certain counties, and they did that in December of 2021, and now it's $800. For anybody else, you're looking at about $700 to I want to say about $950. Sometimes appraisers don't pick up the job, and it says we're looking vigorously to find somebody in the area, and when that happens, they charge anywhere between $700 and $950 for that appraisal. So just depending on the area, how busy it is, and if we can get a appraiser to pick it up.
Yeah, I've noticed that especially last year, that was the biggest part of the process that was delayed is the appraisal, and that was caused a lot of extensions of closing dates. But I feel like it's gone down some in terms of them picking up a lot quicker. Have you experienced that recently?
Yeah, for VA, they're doing an awesome job. I know, I had been seeing, I'm on Facebook and other social media, and I had been seeing some selling agents and even heard, I don't know if it's true or not, but rumors of some builders not wanting to take VA because of the long wait times for appraisals. So I personally worked on 2 deals for VA. I had one in March. I have a couple now, and we ordered the appraisal, they did it in a week, and we've had it back within 2 weeks. So as far as like turn times, though, that's beating conventional appraisals at the time right now. So they're doing a really good job. I think the increase in price a little bit has gotten the appraisers to actually pick up the job quicker. So VAs right now, and as far as turn times on ordering it and getting it back from the appraiser, they're doing an awesome job.
Awesome, man. That's good. That's good to hear, because I know sometimes that delay, as it is, the process could be present itself with a lot of obstacles, and that just adding to it can just be a little bit more stressful. But the fact that it's gone down significantly can definitely, reduce a lot of the stress that I know some of my clients experience, other people experience. So we've gone over the down payment, closing cost appraisal, inspections, and I wanted to cover this one because I know I've had questions about if I've worked with VA, transactions, and there's a little bit of key differences between FHA and conventional versus VA. What about like VA? Do you know about the termite inspections that you can share with us?
Yeah, so the inspections, we usually, we tell all of our buyers, 100% get the inspection, whether it's a new build or a resale, 100% get it. Don't show it to us as lenders because we have to take that into consideration, but, get it. As far as like termite inspections, I just had that conversation this weekend with a couple of real estate agents, and I was asking them, me personally, I've never run into a situation where, termites came back. I have had a situation where they said this might be an issue. They had some pallets in the backyard. So what we told the sellers is, if you're not using the pallets, would you guys mind just throwing them away? So they went and got the pallets, they threw them away. The inspector went back out, and, it was a done deal. I do know that if there is termites on the property, you do have to pay a little bit more of a fee, but in El Paso, it's not really something that we see a lot of. I think El Paso, with the climate that we have and termites, is not really a big deal. They do have to get it. I think it costs anywhere between $70 and about $100 for the termite inspection. But to be honest with you, I've never run into that issue. And fingers crossed, I don't have to run into that for more fees associated with getting into a home.
Right. That's true, man. So we've covered kind of like the basics of what it takes to even just kind of put the skin in the game in terms of putting an offer. But for the audience, I'm going to go ahead and provide a PDF example of what the fees look like of what we just discussed, and then other fees that are associated to also making an offer that's going to be competitive, because there's other factors like paying above appraisal, paying for the title policy, paying for the survey. So I'm going to put that like a spreadsheet of those fees that are associated, that we all can get an idea. But Mitch, let's go into the credit and DTI, so the debt to income ratio. What are the minimum credit scores for VA, FHA, and conventional for them to actually qualify for the loan itself?
So that's kind of a loaded question, but what most lenders say is a 580 will get you by for FHA. For VA, it just depends, because VA does things a lot differently than FHA and conventional. So you can say a 580 is the lowest, but a 580 with what kind of credit profile. So that's the thing that we look at as well. If it's a VA with a 580 that just has high balances on credit cards, there's no collections, no charge-offs, we can probably get by and get you qualified for a loan. However, if it's a 580 with 4 collection accounts, a bunch of late payments on different liabilities, then it becomes a different ballgame. So my rule of thumb for that, and I do some first-time homebuyer courses as well, is I tell everyone a 620 will get you by with FHA and VA. 620 is kind of what we're looking for. It makes it a lot easier to get an approval for you if you have a 620. As far as conventional, 620 is the minimum, but when we say 620, the minimum for conventional, you're looking at probably putting 20% down on a home. For conventional, the number that I use inside my head is usually a 680. A 700 would be better. It makes it a lot easier, but conventional, a little bit higher as far as credit score, probably looking at about a 700 rule of thumb. And then for FHA and VA, if you have a 620, it's a lot easier. You can get away with either the 0% down for VA, or for FHA, the 3.5. With going all the way down to 580, you're looking at either 10% down for FHA, and for VA, like I said, the credit profile has to look good. It has to kind of make sense as far as, looking at the credit profile. But, 620 will get you where you need to go. And then for a conventional, usually looking at about a 700 credit score.
Right. And that, I think it's great that you mentioned that it is a loaded question, because it's hard for us to give people like an exact credit score, how much you're going to be paying and stuff like that, because it's really an individualized basis, right? Like I noticed that a lot of times when I get asked that question, I hesitate to give them a specific answer because it really depends on their situation, because everybody's credit profile is unique and different and can affect how much they qualify, what type of loan. So at the end of the day, I should have prefaced with that, right? But for them to actually speak with a lender to know what it is that they qualify, because it may not be true for another person because of the credit profile being different, right? So
exactly.
That's a good point, man. So as far as the credit score, because I know that we have a minimum credit score for certain types of loans, but you're talking about how the credit profile really dictates if you can qualify or not. I know that there's like a way for them to determine whether, if they can pay a certain amount off. You have a certain program that can help them, determine if they pay a certain amount or do certain things, they can bump up their credit score to be at a qualifying score, right?
Yeah, definitely. So we have two, tools that we use. We have one called Wayfinder and another called the What If Simulator. And what they do is when we run your credit, it gives us all three of the major credit bureaus. You have your Equifax, TransUnion, Experian. And so with the What If Simulator and as far as the Wayfinder, we can run those programs and it'll tell us exactly what to do to get to a certain score. So I can plug in there and I can kind of mess around with stuff, and I can tell some of my clients, hey, you're at a 609 and we'd like to get you to a 620. If you pay off this account and you pay $300 to get it down, and I rerun your credit, I can get you to a 620. And we do that all the time. We have a lot of people that say, hey, I need to work on my credit, and there's so many variables that go into credit scores, and every credit bureau is different on how they calculate their scores. So the most effective way is to fill out a loan application with us, let us take a look at it, use the Wayfinder, use What If Simulator, and kind of give you a step-by-step process as hey, we need to get you to this credit score, here's what you need to do. And those tools are awesome, and it really tells us almost exactly what they need to do in order to get them pre-qualified for a home.
Yeah, for sure. Because at the end of the day, I feel like if someone was looking to buy a home, there needs to be some sort of plan in place if they don't qualify. And with this program that you guys have, you all offer solutions. And I feel like at the end of the day, having a solution from the source itself, from the lender, to see what it is that they can qualify for is probably the best solution that you can have. Because a lot of times people may not feel comfortable in talking to you and giving your credit score and stuff like that. So they may kind of do Google or research on their own of what they can do to increase their credit score. And at the end of the day, if they can't qualify with you, I know that there's an opportunity for them to even go with a credit repair person to get them to the point where they need to be. So those are programs for sure that I feel everybody should take advantage of if they're even considering purchasing a home, maybe a year from now. That way they can have that plan in place, right?
Yeah, definitely.
Yeah. So what about like debt to income? What is debt to income, and how is that measured, and what is like a comfortable threshold for people to have with their debt to income?
Yeah, so that's a good question as well, but it's also one of those questions where it kind of differs per person. Debt to income, we have a front end ratio that we use, and the front end ratio is your proposed housing payment. I'm applying for a $200,000 loan. My proposed housing payment with property taxes and with homeowners insurance is going to be $1,800. So we take that proposed housing payment and we take your gross monthly income, so before taxes. And what we do is we take your income divided by your proposed housing payment, and it gives us a percentage. For the front end, which is just your proposed housing payment divided by your monthly gross income, we get a certain number. We have numbers in our head that we kind of use. For my purposes, I use usually 40 is what I use for front end. Anything above 40 and it's kind of pushing it. And, like I said before, we want to make sure that our clients are comfortable with their monthly payment. We don't want them paying anything that, is gonna hurt, because we are using your gross income, and that's, before taxes, obviously. So we don't want to put you in something that's going to make it very tough for you. And that's a conversation we have once we meet with people, try to get you pre-qualified. So 40 on the front end. If you want to be really comfortable, I would say probably 35 or 30 as far as your front end. The back end DTI is the one that's used more commonly, and that takes your proposed housing payment and all your monthly liabilities. So your car payment, any credit card payments that you make, it's your minimum payment. Student loans, we do factor those in as well, and we use a certain percentage for those as well. So any monthly payment or monthly liability that you have, plus your proposed housing payment, divided by your gross income. For conventional, the number in mind that I usually have is 50, and that's the 50% of your gross income is where you kind of want to be. But for VA and FHA, we can go a little bit higher. But again, that's a conversation that we have with our clients and kind of go over that with them and say, conventional, you can go up to 50. For FHA, we can usually do 56. For VA, you can go a little bit higher, but we tell people, hey, this is what you're making. This is your gross monthly income. This is your payment. Is that something you feel comfortable with? And if they're comfortable with it, then obviously we proceed. But that's the conversation that you should always have with your lender and kind of go over with them.
Yeah, for sure, man. And as you were saying that, I was thinking about with the student loans, right? Sometimes, and then correct me if I'm wrong, but my understanding is that if there's student loans and they're on forbearance, those they're still calculated into the DTI, right?
Yeah, so that's the interesting part about being in the going through this COVID era is student loans have been in deferment since March of 2020, and they've still deferred it, and they keep going further and further back. So when we run a credit report on somebody and they have student loans, the monthly payment is saying 0, but Fannie Mae makes us take somewhat of a, what we say is we hit you for a payment, but what we're doing is we're calculating basically a minimum payment that you'll have to make. So what we use is either a 0.5% FHA, and then for conventional we use a 1% of what your overall balance is, and that's what we use for your monthly payment. So we do have to add that in there because sometimes people have student loans. Maybe they got their doctoral degree, maybe they got their master's degree. So you will eventually have to pay that back. So we do have to take that into consideration.
Right. And that makes sense, man, because I feel if there would be an injustice for us to not include that, because it's going to eventually catch up to them, and then you don't want to put them in a position where like they're going to be tight and have to make the mortgage payment and have to decide between the two. So that definitely makes a lot of sense. Jumping into like the W-2 and 1089, because I know that that's been an obstacle for some people if they're self-employed or independent contractors in terms of like the how many years of experience. But let's start off with W-2, because I know there's been instances in which like a teacher or somebody that's like a nurse has been in school and then they jump right into the profession. Do their years of experience as a student count towards the overall years of experience as well?
Yeah, that's a great question. So that's something that we try to tell people. We usually look for a 2-year work history for FHA and VA, conventional as well. But if you did go to school and you just got out, we can use your school as your 2-year work history. So if you went to school as a nurse, obviously you went to get your bachelor's degree, so you went 4 years. We would use your unofficial transcripts, and then we would add that on to your employment, and that would give us the 2 years. There's a lot of misconception as far as, do I have to have 2 years at one specific job, or can it be just one job? And usually what we tell them is we just need a 2-year work history. If that involves school too, that does count. Because, when you're going to school, you're getting training to be, get into the profession that you went into. So we can count that. Let's just say that I had a job at Walmart and I switched and got a job at Costco. I was at Walmart for a year and now I'm at Costco for, 6 months. We can definitely use that as well. So as long as you didn't change jobs, I think the rule of thumb is 4 times in 1 year, which is very uncommon. We can use any previous employment. So 2-year work history is what we look for. That's what we generally tell people for W-2, and that's usually what works.
And for 1089, I think that's where it starts. Like there's there's not as much gray area as there is for W-2, right? So let's say, for instance, someone went to school for a certain profession, let's say business, right? And then they end up getting their own business, which ends up being a 1099. Can they use those years of experience, or does it have to be with that business for 2 years or whatever minimum y'all have?
Yeah, that's the most common question, and I think what we're seeing right now is there's a lot of traveling nurses, and that's kind of what's come up, at least with me and my coworkers here at our Zaragoza branch. But if you went to school and got a 1099, what we use for the 1099 is we use your Schedule C, your profit and loss from business, and we use your tax return, and we use that and we average it over 2 years. So school in that situation would count towards your employment history. However, we do need, for somebody that's self-employed and has their own business, we do need 2-year tax return in order to qualify you. We have to average it out and kind of see what your income is like, because at the end of the day, the lender wants to make sure that any loan that they give out can be repaid. So that's for your conforming, your Fannie Mae, your Freddie Mac. If somebody was really interested, and we've had some traveling nurses that have come to El Paso, decided that they really liked it and wanted to purchase a home, but I only have 1 year 1099. Our company has a 1099 1-year program that we can use, and we have been able to do that. It does come with a little bit higher of a down payment at 10%, but it's definitely something that somebody can do, especially for our truck drivers, for our medical professionals, because having 1 year 1099 and then to say, hey, you have to wait another year to get another 1099 and another tax return. For some people that are starting a family, it's a long time. So we have alternative programs that we can use, but rule of thumb for 1099s is usually we have to have 2-year tax return.
Got it. Yeah, that I've had people ask me, about that, because there's really a risk that the lender themselves are weighing, right? So if they only have 1 year of experience with their own business, to kind of weigh the risk and make the risk go a little bit lower, it makes sense to give a little bit more down, so that they won't, so that the risk isn't as great as if they were to do a normal down payment with that 1 year of experience. But yeah, that definitely makes some sense, man. So there is I completely forgot. There's another topic that I wanted to bring up. Oh, the down payment assistance program. So I know that wasn't part of the questions, Mitch, but the down payment assistance programs, there's a term that people use is the first-time home buyers program. But essentially, what is that really? Is the first-time home buyers program?
So first-time home buyer is kind of hard because they hear it and they're like, am I a first-time home buyer? Yes, but first-time home buyer is defined as, have you owned a home within the last 3 years? So if I owned a home and I sold it, and let's just say I was renting or staying with family, and I wanted to repurchase in 3 years, I would become a first-time home buyer again. So the state of Texas has 2 programs. We have TSHAC and we have TDHCA. Those are the acronyms that we use for them. Those are both great programs for people, especially first-time home buyers, especially with them having to pay closing costs now that we can get people into. Rule of thumb with that one as well is the minimum credit score is 620. The only issue with, I guess right now with TDHCA and TSHAC is that interest rates are going up, and the rates for those are significantly higher than if you were to qualify and pay your own down payment. So, obviously the money is there, and first-time home buyers that need assistance in getting into a home, they can definitely use it. However, we do go over that with our clients and tell them, if you were to come in with your own 3.5%, you would pay 4.875, 4.75, depending on their credit score. But if you were to go to down payment assistance, I think as of today, it's at a 6.125. So, it comes with a little bit higher of an interest rate, but like they say, nothing in this world is free. So it's kind of along those lines, but it's definitely there if people want to use it. But we warn people and say, if you came in with your own, it would be different than using the assistance.
Okay, yeah, that makes sense. And the advice that I've given before to my clients is that in the front end, using the down payment assistance, you'll be able to, have someone pay for the down payment. But in the back end, over the long period of time, it's gonna multiply for sure, way more than what you're borrowing. But
yeah, you're going to pay it back with interest is really what it is. But, like I said, it's there for the people that want to use it. And it's definitely a resource for people to help them out with closing costs and for their down payment. So, I mean, it's really up to them.
Yeah, that makes sense, man. So yeah, that's pretty much all the questions that I've had for you, Mitch. I'd love to bring you on again because there's a ton of other information out there that we can share. But I wanted to ask, where can people reach you in the event they want to get a hold of you to get pre-qualified or have any other questions?
Yeah, sure. So what I'll have you do is I'll just, I'll shoot you my business card. I am on social media. I'm not on there, and my presence isn't as much as I'd like. But and you know how it is right now. It's super busy. But I'll give you my information. People can reach out to me. I'll put my cell phone number on there and everything, and I'll give you my social media as well. But pretty easy to contact. You can call or text me anytime, and I'll answer those questions. And yeah, man. I mean, here to help people and try to get people into homes.
Cool, man. Well, I appreciate your time. Thank you so much. But we'll catch you in another video, okay?
Yeah, man. Sounds good. Appreciate you having me. And any questions or anything, just let me know.
Sounds good.